Hello, everyone. Artificial intelligence has been one of the hottest themes in the stock market, and recently, one particular name has captured the attention of retail investors, Bigbear.Ai. In just the past month, this stock has climbed more than 46%, sparking excitement, curiosity, and even debate among traders and long-term investors alike. The big question that keeps coming up is simple. Is Bigbear.Ai still a bargain waiting to be recognized, or has the market already pushed it far beyond its true worth? At the time I'm recording this, the stock is trading a little above $8 per share. That may not sound like a lot compared to mega-cap AI companies, but for a firm of this size, it's a massive run-up in such a short period of time. And this surge didn't happen in a vacuum. To really understand what's fueling the move, and whether it's sustainable, we need to unpack a few key developments surrounding the company, its financials, and the broader market backdrop. First, let's look at what Bigbear.Ai itself has been up to. Recently, the company raised fresh capital by selling shares, which increased its cash balance to roughly $390 million. According to management, this war chest isn't just going to sit idle. They've made it clear that their strategy is to put that money to work aggressively, targeting new opportunities both organically, by expanding their own products and services, and inorganically, meaning possible acquisitions or partnerships. The leadership team emphasized discipline and urgency, suggesting that they don't want to let these funds go to waste. Now, on paper, that might sound like a strong growth story, but investors haven't always been convinced. The reality is that despite deploying capital in the past, Bigbear.Ai has struggled to show consistent revenue growth. Their most recent quarterly earnings left Wall Street underwhelmed, with results that many would describe as lackluster at best. So while the strategy of using cash to fuel expansion makes sense, execution has been the weak spot, and that's part of the reason why the stock was not very appealing to many analysts just a few months ago. So why the sudden enthusiasm now? A big part of the answer lies not in the company itself, but in the macroeconomic environment. Over the past month, interest rates have been declining, and that shift has major implications for growth stocks like Bigbear.Ai. Think of it this way. When rates are high, investors can earn safe returns by parking money in bonds or savings accounts. But when rates start dropping, those safe returns shrink, and suddenly, riskier growth stocks with the potential for big future payoffs look a lot more attractive. Bigbear.Ai falls squarely into that category of future-oriented companies. Their projections show that free cash flow will remain negative for several years, with heavy losses in 2025 and 2026, and still negative in 2027. To put numbers on it, they expect losses of over $1 billion in free cash flow by 2025, narrowing to around negative $570 million in 2027. Positive free cash flow isn't projected until 2028, when they hope to finally turn things around with about $150 million in cash generation, and then gradually increase from there, potentially reaching more than $500 million annually by 2034. This is why interest rate movements matter so much. For companies like Bigbear.Ai, most of their value is tied to what they might earn years down the road. When rates are lower, those future dollars look more valuable in today's terms. That dynamic is one reason Bigbear.Ai's share price has skyrocketed recently. We've seen the same effect with companies like Tesla, where a big chunk of the valuation rests not on current car sales, but on the promise of future technologies like full self-driving and robotics. But here's where the analysis gets tricky. Just because the stock is up doesn't automatically mean it's worth the current price. In fact, when we dig into valuation models, Bigbear.Ai looks significantly overvalued. Based on calculations using the present value of expected future cash flows, the company's intrinsic value per share comes out to only about 1.34, compared to the current market price of just over $8. That's a huge gap. Why such a low valuation compared to the trading price? A big factor is the discount rate applied to those future cash flows. Because Bigbear.Ai is considered highly risky, the stock has a beta of 3.15, which means it's more than 3 times as volatile as the overall market. Analysts apply a steep discount. Combining this risk factor with a risk-free rate of about 4% and a market risk premium of 6% leads to a cost of equity around 23%. With such a high hurdle rate, even optimistic future cash flow projections don't justify today's market price. Now, that doesn't mean investors can't make money in the short term. Just today, for example, Bigbear.AI stock jumped nearly 15%, even as the broader market sold off. Retail traders in particular love this stock. Part of the appeal is its low share price, under $10, which makes it feel more accessible, and of course the magic of having AI in the company name. Ever since 2023, AI-themed stocks have been among the most talked about and heavily traded names in the market, and that trend continues here in 2025. But stepping back, the bigger picture remains sobering. With negative free cash flow projected for several more years, heavy reliance on favorable interest rate conditions, and intrinsic value estimates far below the current price, it's hard to argue that Bigbear.Ai is a bargain right now. Instead, it looks like a classic case of market enthusiasm running ahead of fundamentals. So, to sum it all up, yes, Bigbear.Ai has enjoyed an incredible run in the last month, boosted by falling interest rates and the hype surrounding artificial intelligence. Yes, the company has a sizable cash position and ambitious plans to fuel growth. But when you strip away the excitement and look purely at valuation, the stock appears overvalued at current levels. That doesn't mean traders can't ride the momentum, but for long-term investors, caution is probably the wiser approach.